Hi, everyone. This is Jason Bjork of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast interview. Today's special guest is a returning guest. He used to work at top-tier investment banks such as JP Morgan, Lehman Brothers, Robert Fleming, and Invesco. He became tired of the corporate life and has built and sold multiple million-dollar companies, overseen $35 million in venture capital. We definitely want to get his opinions now because it looks like we're having a venture capital bust with Silicon Valley Bank, all the while investing full-time, managing his own and private client wealth. Also, he has paid investment newsletters over at Capitalist Exploits. Chris MacIntosh, thank you for joining me again.
No worries. Good to be back. It's good to be back. Okay, before we get started, I actually just remembered my compliance team has been hounding me on this stuff, so I've just got to mention that the other business that we have, which is an asset management business, is an SEC registered business, and as such, basically ignore everything that I'm going to say. It's not advice, and do your own due diligence, etc., etc. So that now the three-letter agencies and the pointy shoes can be happy that we're not giving any advice. We can carry on.
And we're recording this interview on Tuesday, March 14th, 2023. We just had the CPI number out. We just had the CPI number out, but I actually want to ask you about the Fed rate hike. So you wrote a piece about a year ago talking about the hidden costs of rising rates. Do you think that the Fed rate hikes are finally breaking things?
Oh, no doubt. No doubt. It's not just the Fed hikes. What you've got is you've got Fed hikes at the same time that we've had a serious constriction in supply chains. We've had a constriction in most everything, especially commodities where we're focused on, which is basically not the I want, but the I must have part of the world. So, basically, if you think about Maslow's hierarchy of needs, it's not the iPhone that you really want, or it's not the new hot tub or the Lambo. It's what you need. So it's food, it's energy, and it's things of that description. And so we've had a significant constraints in those, in particular in the fossil fuels. And so that has now combined at the same time with rate hikes. And so rate hikes, of course, increase the cost of capital, which makes, especially in those industry I've just mentioned, it requires the industry to recalibrate, right? So, for example, if your base cost or base profitability on any, say, just take a mine, for example, and you know this well because you cover it extensively and very well. If your base cost happens to be X and now your cost of capital goes up by some number, you have to look forward and say, okay, what does that mean in terms of all my operating expenditure? And hence, can I go ahead with this project that I've had planned? And in many instances, they get mothballed until such time as then the price moves higher to make that particular project viable. And then when you have a continuous series of rate hikes, markets being forward-looking, they don't just price that new point. They now price increasing rate hikes on a go-forward basis. And as you would also know, in very capital-intensive industries, that requires you to be looking out 10 years sometimes, and in some instances even more. So it's very constraining in terms of the ability to bring additional supply into the market, and it's extraordinarily inflationary on those hard commodities. At the same time, it can be very deflationary for many others. In particular, what you're doing is you're actually creating an environment where you're, at least from a retail perspective, your disposable income shrinks. And so, that Netflix subscription might not look as important as it did last year, sort of thing. So it's an interesting market to be analyzing and investing in, and it's not. There are sectors, there are winners, and there are losers. I would suggest there are less winners than there are losers. However, the winners tend to be more asymmetric.
And I think with commodities, we're starting to get to the point now where the production costs are rising. So you have labor costs in a lot of these areas in emerging markets because the dollar has been strong. That normally means that emerging market currencies are weak, and there's bad inflation in a lot of emerging markets, especially where a lot of miners and a lot of commodity companies operate. So labor costs are going up a lot. These margins are getting squeezed. You brought up cost of capital. I mean, that's one of the most important input costs for a lot of these mining and commodity companies is their capital costs. So labor costs, capital costs, and then their energy costs. All these things over the last 2, 3, 4 years are up enormously now compared to the past.
100%. And it's not just the cost of capital, it's also the availability of capital. And so let me give you an example. Okay, we know cost of capital has gone higher. Let's just say for shits and giggles, we wanted to put a new VLCC on the water. We're a shipping company, right? Let's go and we realize that tanker stocks are doing very well, and we're very profitable. We're a tanker company. We want to go and put a few more of these things on the water. Now the cost of capital is higher, right? The materials going into that are more expensive than they were 3, 4, 5 years ago. So those are all input costs that we need to account for, and that's fine. We can pre-order and we can get to a point where we can see whether that's going to be profitable for us to move forward, including that higher cost of capital, even on a go-forward basis. If we said, okay, this is a 30-year lifespan for this vessel, what does it look like, and run the numbers, and it's still very profitable, we go, cool, let's go. We've got a couple of issues now that still stand in our way. One, in the last downturn, in the last peak in the shipping market, I'm just using shipping as an example, but this is true across many of the sectors that we cover in the commodity space. What happened was a decimation of the industry, and at the same time, even shipyards went bust. A lot of them holding inventory of bankrupt companies, and so there's a lack of shipbuilding capacity. Now, on top of that, if you and I are running this company, we go, okay, well, this is all good. The profitability is here because day rates are climbing and we're printing money. So let's go ahead. But these things are not inexpensive. We're looking at $50, $100 million to put one of these things on the water. So that's not going to be equity financed. That's debt financed. So now we go to the debt markets and we say, hey, okay, who's going to finance this? Largely in the Western world, this is now massively constrained, not because of the cost of capital, but because of an ideology. And that ideology basically says that you're killing Pachamama because you're involved in, quote unquote, the fossil fuel space in some shape or form. And there are a lot of ideological, political considerations that one must make, especially if you're at a large institution where the bulk of your business is maybe not in that sector. You're going to get sanctioned, you're going to get cancelled, you're going to be ostracized if you're investing into or funding some of these sectors. And so the ability to go and raise capital or your debt in many of these markets is constrained even more than if we just look at the metrics, the simple metrics of the cost of capital as a consequence of higher interest rates and the cost of manufacturing and so on and so forth. So this is really a perfect storm in many instances for many of these industries, which I would suggest are critical to the functioning of society. In other words, must-haves.
Well, I call ESG now the energy spending grift.
Exactly. It's precisely what it is, which is interesting because what it's doing is also it's splitting the world on a geopolitical basis. There is the broadly Western world, which is following this climate hysteria path. And then there is the other part of the world, largely the BRICS. And I'm sure some people will call me out and go, oh, but what about this and what about that? No, like just broadly. Okay, so don't get too caught up in the minor details. Broadly, that is the situation whereby the the capital and the business is moving from west to east, from the Western Hemisphere or Western allied countries to the east. And so we're seeing this at breakneck speed, quite frankly, which is quite fascinating to watch. But it's also important from an investment perspective to understand that that is taking place.
And oil prices have really taken a dive lately. I know natural gas prices crashed in the last couple of months. We've had a little rally here. Natural gas prices were down around $2 here in the United States. West Texas Intermediate prices were around $70 today. They're a little bit above that right now, but we're getting dangerously close, Chris, to the cost of production for a lot of these oil producers now.
And I mean, look, on the natural gas side of things, there is a greater ability to bring on supply than there is in, say, the oil space. But it's still not an immediate fix. It's not like there's a tap, you just go, oh, fuck it, all right, well, let's turn it on because we're short supply. And this is an important concept for many to understand. In many instances here, what you're looking at is the ability to bring on that supply takes time. And not only that, your ability to bring capital into that market in what is a very uncertain political environment. You don't know whether some politician just turns around and decides that there's now a new tax that is being implemented on your particular industry and hence your company. And so all of those spreadsheets that you've just built that depict your outcomes for capital that you're going to invest now have to be recalibrated as a consequence of some new legislation that gets passed. For example, in Ireland, earlier when was it? It was late last year or early this year. They passed a new 70% windfall tax, right? So you're sitting there and you think, okay, I've done all my numbers. This is all well and good. Let's move forward and let's go and spend $1 billion or whatever it is on X, Y, Z. And then all of a sudden, these retards come along and plonk this new tax on you. So now you've got to recalibrate your entire business. And what's happening in many instances is it creates incredible uncertainty. So you tend to just hold back. You go, well, I don't really know what this environment's going to look like. Yes, I can see that the profitability is high. Yes, I can see there's a shortage of supply, but you're not prepared to take that capital risk. And even if you are, as a CEO, you might not have shareholders or capital providers that see things in the same light. And so everybody sort of holds back. And so again, prices just keep moving forward higher. And we will have incredible volatility throughout this space, because let's not forget there is demand destruction taking place at the same time. But this is true across much of the energy spectrum. You mentioned natural gas. Natural gas, at least in the United States, is still largely a domestic-driven economy. But, you look at if you look at the alternatives that you have you've got quite a few in the US. You've got coal, you've got natural gas, you've got oil, you even have some nuclear. There's a kind of almost like a play between each and every one of them, depending on state as well, right? So we're going to see winners with respect to blue states, red states, things of that nature. And so that in itself is actually creating an internal dynamic within the country where you're seeing capital moving to, should we call it, safer jurisdictions. And I don't see that changing a whole lot. And so it just means that from an investment perspective, where you are deploying capital, we are very much in a political environment. It's critically important to understand the underlying dynamics, the fundamentals, as you've alluded to, for example, the cost of actual production. And these tend to be pivotal points where you can fairly safely deploy capital When I say safely, what I mean is from a risk perspective, you can allocate and say, okay, I'm prepared to put 5% or 10% or whatever it is into this sector, because I know that it cannot last forever in a situation of supply deficit, and where the cost of the actual production isn't met by consequent higher prices. That can last for some time, but eventually your inventories run out. So those are points in time where we can make a judgment call as to when to allocate and potentially how much percentage we can allocate. But it's also important to look at the distribution of those assets across jurisdictions. You kind of don't want to be the guy who gets it right and says, okay, fine, I bottom tick natty gas, only to find that you went and you invested into a couple of companies that land up just basically going bust because of some political decision that gets made in XYZ state or country. This is not just true domestically in the United States, it's true on an international basis. Europe being poster child for this woke ideology that's hampering a lot of supply.
And a lot of these policies, especially energy policies, they don't make a lot of sense. They're heavily politicized. For example, you have a lot of these countries, they have oil and natural gas drilling bans domestically, but the politicians are just announcing that they're going to commit billions of dollars to liquefy natural gas import facilities. Well, those are going to take years, they're very expensive. And then where's the natural gas supply going to come from?
You can't make up some of the stuff. It's incredible. Look, we've been touching on the commodity space, Jason, and we've been touching on some of the dynamics internally within the United States. But here's something else to consider. I've been watching, for example, this collapse of Silicon Valley Bank, which wasn't really, it wasn't a solvency issue. There was solvent. It was more like a liquidity issue from what I can tell. But despite that, so while that's been taking place, I'm not sure anybody noticed, but there's two things that happened which tie in very closely to this entire energy market, to the geopolitical environment that we have alluded to a little bit here. And it's two things. One, Mexico just applied to BRICS. And two, Saudi and Iran just made friends via China, brokering that particular deal. Those, I would suggest, are incredibly important things. The first being Mexico, which is on the border of the United States and has always been heavily under the influence of the United States, which is basically diverging now, saying, well, we're kind of putting a foot in another camp, so to speak. That's a significant event. The other is, I would suggest, even more significant, which is the Saudi-Iran thing, because this is back to what was called the Mackinder Doctrine and the Heartland Theory. And this theory is, very briefly, I'll give it just a snapshot, is that he who controls the heartland, which is Eurasia, controls the world. There's a couple of reasons why that's largely true. One is the energy in that in the Middle East. The second is a number of geopolitical choke points and transportation and so on and so forth. And so the US's foreign policy has always been, or has for many, many decades now, been built on that heartland theory. And theory was that you needed to control that heartland. And if you didn't control it or couldn't control it, you had to make damn sure that nobody else did, which is why the US government and deep state had, for decades now, funded wars on both sides in order to keep that area destabilized, just to keep people fighting with one another, to ensure that no one ever actually gains any real foothold geopolitically within that area. So this tie-up between Saudi and Iran via China brings in this whole, this is them losing the heartland. And remember, this is where the bulk of the energy in the world lies. And then it's not a surprise to me to watch at the same time that you're seeing Russia, China, Saudi, all of them actually delinking from the dollar. So, this is not just about commodity supply, although that is true. This is also about who gets the supply. If we go back and we think about the oil spike in the 70s, that wasn't about supply. There was a lot of supply in the market available. What it was about the availability to get that supply. So this is a situation we're moving into, I think, very, very quickly. I think it would be difficult for me to make a case for being bearish energy assets when you're going into a geopolitical war, which we're already in, because you don't have any political security without energy security. And Europe's finding that out very, very quickly.
And
they now are essentially vassal states to the United States, and they are in the process of deindustrializing.
Well, we're also right around the cost of production, and there's been a lack of investment in CapEx for a lot of these projects too on the supply side. The other thing here, and you brought up bad policy, I mean, there was sanctions, right, with Russia and Ukraine. So Germany and the rest of the United Kingdom, the rest of the European Union couldn't buy natural gas or oil from Russia. So what happened? The Russians sold it to the Chinese. And then when the natural gas price and LNG price went absolutely ballistic in Germany and the European Union, the Chinese turned around and resold that LNG and the natural gas they bought from Russia cheap. And they resold it to Germany and the European Union at sky high prices over the summer in 2022.
As did India. As did Saudi. So what the Saudis did was they actually just they sold their oil and then replaced the domestic consumption with Russian oil. So they could ostensibly say, well, we're not selling you Russian oil. We're not selling on Russian oil. And they weren't. But of course, they sold their oil at a premium and they bought Russian oil at a discount.
So it just shows that these policies, there's ways around it. The free market creates a black market if there's a hole in the government and bureaucrat policies.
Which is what they're attempting to shut down. They're attempting to shut down every avenue of stopping any parties being participant to the countries that they're sanctioning. We only need to look at the last at the sanctions that have been placed on Russia to see that it's been the biggest boomerang, arguably in history, of a policy backfiring, because frankly, it's had the greatest negative effect has been not on Russia but on Europe, who now are paying an absolute premium for energy, which is causing inflation to spike across the European Union, while simultaneously bringing in greater profits to the Russian state. And so their GDP growth is roughly twice that of the US, and much, much more depending on the European country that you might pick to analyze it against. So it's been an overwhelming, absolutely disastrous policy. And so instead of repealing it, they've just kept pushing and attempting, almost like in a whack-a-mole situation, to shut down anybody else that might choose to deal with them. But to your point, the black market always functions. There's always an arbitrage to be closed. So, India closed that arbitrage. China closed that arbitrage. Saudi closed that arbitrage and profited handsomely in the process. But we're not seeing, unfortunately, we're not seeing any change from the Western perspective, certainly from the United States government. We're not seeing them learn their lessons. Instead, they're just doubling down on the same idiotic policies that not only don't work, but actually act to backfire against them.
Or taking out the Nord Stream pipelines, or whoever took them out. Yeah, I doubt it was Putin.
No, I mean that's I think anybody who believes that is possibly dropped on their head as a child or starved of oxygen, because if he wanted to shut off that pipeline, he has the tap to do so. Why would you destroy the one point of leverage that you have, which is that supply of gas into Europe. Why would you destroy it? You wouldn't destroy it. You might turn it on and off, but it gives you that ability to negotiate. Now that it's gone, you don't have the ability to negotiate. So the very idea that Russia did that is beyond absurd.
These countries also that are running trade surpluses, they're not recycling their foreign exchange reserves back into US treasuries, even though they can earn over 5% right now. So instead, what they've been doing over the last 12, 18, 24 months, they've been enormous net buyers of gold. I mean, we've just seen in the last month or two, Singapore bought another 44 metric tons. The People's Bank of China has announced more purchases over the last 4 months consecutively. So we're just seeing a lot of countries that in the past may have recycled their foreign exchange reserves into treasuries that are not net buyers anymore.
And why would you be? You know, the entire world just got put on notice when Russia's reserves were stolen or frozen. Pick your word, pick your terminology. So it wasn't necessarily about the, that was a weapon that you get to use once. And you get to use it once because you notified the entire world that they can be in the same position should they diverge in opinion on any matter, regardless. That's a weapon that they could and will clearly now use. And so as a consequence, if you're in that situation, what do? Well, you take measures to mitigate risk. It's what we always do. It's what we do as human beings. It's what we do in businesses. And it's what countries do at scale, is to mitigate any obvious risks. And so it's not necessarily a matter of selling US treasuries, but it's certainly where you have capital inflows, for example, China. It's a matter of not purchasing as many on a go-forward basis. Because ultimately what I see happening here is a tiptoeing out of the kitchen with an attempt to sort of deleverage yourself to some respect from US treasuries. But there's a lot of other factors that play into this, because people will look at that and say, well, that's the end of the dollar. Possibly, but I think the dollar can actually fail upwards, and largely that's not because foreign central banks are buying gold and not buying treasuries, because clearly that would be that would cause downward pressure on the dollar. But ultimately, if you go back and you look at the main source of capital in the world, it's credit creation. Professor Richard Werner's actually got some fantastic stuff on this. If anybody wants to sort of delve into it, he's a great follow. But what we have is now a credit contraction. M2 has growth is now year over year is actually below zero. That's, I think, happened something like 5 times in the last 100 odd years. It's never been good. It happened in the 30s, and so you get this significant credit contraction. So even while you might have foreign central banks that are not purchasing US treasuries, where the supply of them is being constrained, it can actually fail upwards, if that makes sense. So there's a lot of things going on at the same time, and it can be quite confusing for people because they're going to look at prices and so, and then justify that, or there will be narratives that get built around why a price has moved. I mean, we've seen this before. You could have some stupid, ridiculous, like think about monkey JPEGs. The prices kept going higher, and then people found justifications for why the prices go higher. Markets build narratives. And so I think we'll see the same sort of thing taking place, but it's important to understand why it's taking place. If that transpires, as I think it might, to not get caught in what can be a whipsaw, because ultimately what we're seeing on a geopolitical basis is a delinking from the dollar. So ostensibly people would then expect the dollar to die. But I think, like I said, there's other things taking place which are overwhelmingly larger, i.e. credit creation. But So on the short term, you can look at things, and then on a longer term, you go, well, where's this headed? Well, the issue, at least in terms of kind of moving into currencies a little bit here, the issue that you would have if you're China or Russia or any of these BRICS countries is that none of them really trust each other's currencies, and neither should they, quite frankly, which is where I think I see them increasing, and you alluded to this, their reserves of gold. So I think gold can come back as an anchor, excuse me, to a monetary system that they put together, which by force they have to use because the risk to utilizing the dollar has become too great. Yes, there's massive liquidity in the dollar system. It's worked for them for so long. There's still trust and so on and so forth. But these become problematic, as Russia found with holding USD reserves. And now we see Blinken going and basically threatening China. If you were China and you didn't take some measures to mitigate the risks that you have to holding what is roughly $1 trillion in treasuries, then you're bloody stupid. So this is going to happen regardless. And by the way, I'm not a champion for China or the CCP at all. This is just real politics, and you got to understand that there are different biases, and there are monetary flows that will take place as a consequence. So when you put all of these things together, what our challenge is, at least my challenge as an asset manager, is to build a portfolio that can hopefully manage in all the probable outcomes, right? So you've got the currency side of things, and then you've got the real hard assets, which we've alluded to. So ultimately, I think we have short-term huge volatility, and we could have a credit contraction that is very bullish on the dollar, but on an international basis, we're still seeing capital that's going to be moving towards gold as a monetary instrument, but also because we almost certainly, I think, are going to go into a kinetic war that's greater than just the Ukraine conflict. Then it's going to be things like oil. I've never ever seen a war that's deflationary, so we've got that going for us. Yeah, lots to consider.
And historically, with these rate hiking cycles, especially post 2008, and the amount of zero interest rate policy and how much these corporations borrowed, and then governments kept ramping up their debts too. Historically, though, when these rate hiking cycles occur, there's bankruptcies, and I don't think we've seen anywhere near the bankruptcies that can potentially happen. But if the Fed's going to do covert bailouts, Chris, and change the rules and say no losses for taxpayers, the FDIC is going to bail out every single bank account over 250,000. I guess the rules are going to keep changing, and it's going to be difficult to figure out what's going to be allowed to go bankrupt.
Here's the thing. The Fed now is backstopping all deposits. Now, put your tinfoil hat on, and let's go back and have a look at these globalists at the World Economic Forum who've said no, they want to have a one central currency system, basically a single line with a central bank that you will have, which will allow them the availability to control issuance of currency. It'll also be a programmable currency, and so they can implement their carbon scoring and all this other nonsense. What better way to get there than to have a situation where the Fed backstops all deposits? So now you might as well just have a bloody account with the Fed, right? What's the difference, right? Also, what is going to take place as a consequence of this is that you're going to have a consolidation of capital in the major banks, in the big six banks, 5-6 banks. And it's also going to be inflationary because you're going to, what's the US deposit base? 17.6, I think it is, trillion. Fed's balance sheet's about 8.4. The Fed's just basically become the FDIC. Right, so you've got this entire backstopping of that system, You've just taken a 250 FDIC limit and just said, that's all right, we're moving it all onto the Fed's balance sheet. So who eats those losses? It's very, very worrisome on that
Whoever
front.
holds dollars, right? Whoever holds dollars long term is going to get debased or devalued.
Ultimately, it's massively inflationary. But I think what's happening is they're prepping for an ability to implement CBDCs, whereby you've got the centralization of risk is now with the Fed. It's completely centralized. So the next crisis that comes along, whether it's manufactured or real, doesn't really matter. They will have but they'll go, oh, well, look, we've backstopped, we've done everything we can here, but you know what? We have to, there's a new crisis and we have to move to it. And now we need this new system. Look, on the social side of things, we know that they're bankrupt. We know that the unfunded liabilities are unpayable. Heck, they're bloody backstopping Ukrainian pension funds now, which is ridiculous because they can't even manage their own pension funds. But here we are. So ultimately, I think we start moving into a situation whereby they're going to rush out they're going to have some panic and they're going to try and rush out a CBDC. The thing is, the world doesn't operate in a vacuum. So while this is all taking place, we've got, for example, the Saudis, the Chinese, the Russians, the BRICS. It's not a surprise to me that I suddenly see Mexico saying, "Hands up, I'll join the BRICS too." Look, these people are all they might be stupid, but they're watching these things too. Analysts at all of these central banks, and you can bet that there are negotiations and discussions being had with respect to the monetary side of things, where countries are essentially getting themselves on a war footing, and so this is not happening in a vacuum. For us, it's very difficult to try and fathom which currency ultimately lands up being the sort of new reserve currency, if you will. If they succeed in getting a central bank currency through, that is the overwhelming, powerful one. I don't think that's probable for a number of reasons, but in the interim, I don't think we necessarily need to make that judgment call. We can simply own the underlying assets that should underpin any currency because it has value. And so if we look at what the BRICS have been suggesting, and this was suggested by Lavrov, as well as trying to think of the other gentleman's name at the Arab League it was the Arab League conference in 2020, I think it was 2020 or late 2020. And they kind of laid it out as to like a floating currency system, which was backed by a number of hard commodities. A lot of these theories have existed for some time, so they're not particularly new. What's new is the urgency to actually implement something as a consequence of the risks that countries now face. So when we see this fairly almost panicked situations where you're seeing countries now joining these BRICS, like why is it we've just seen Mexico do this? Why is it that the Saudis and the Iranians have just made friends after hating each other for so long? The point is they see that there are risks to them that exceed their own internal political problems with one another. It's a little bit like if you and I have got I don't know, you dated my sister and you were, you dumped her and I don't like you for it, whatever it is. But now we're walking down an alley and there's three guys coming at us. It's like, okay, we're going to put our differences aside and we're going to try and, and so this is sort of what's happening on a international scale.
I also see that the global economy is not on a sustainable path anymore. I see a government debt crisis. Japan was doing yield curve control and zombie banks for over 30 years. It looks like they're finally hitting the wall right now where they don't have any good options left.
Very much seeing it the same way. Look, this is this is the tail end of the bull market in bonds. It is a debt crisis, which will morph most probably into a currency crisis, because that's what happens. Because if you think about what is debt, what is sovereign debt? Well, it's long dated currency, so it's not really possible for you to have a sovereign debt crisis while simultaneously not having that usher in a currency crisis. So, and there is an attempt to front run this and bring in this very controlling central bank digital currency system, and I've made the case for this now for years, even before COVID came along and knocked on our doors. And it was the idea that they will default on domestic liabilities, pensions and healthcare and a whole host of things, because quite frankly, they're unpayable. So they'll default on those, bring in this controlling system so that you can't escape. And then at the same time offer some crumbs, which is always to placate the masses, and that those crumbs will be UBI. However, the UBI itself will be very tied to what they want you to do, right? So you're going to live in your 15-minute city, you're going to eat their bugs, and you're going to not travel.
You have to behave on the animal farm.
Pretty much. So, but again, things don't happen in a vacuum, right? So, if you go and you read that report put up by the United Nations, I think it's 2040, in the United Kingdom, they intend to only have 2 airports operating. And you go, well, how's that? Someone said to me, well, how are people going to fly? I'm like, well, they don't expect you to fly. You're not going to fly. It's only the elites that are going to fly.
You're going
to. I'm like, yes.
You're going to do Zoom calls.
Exactly. You're going to live in your 15-minute city. You're not going to own a car, right? Because there'll be no point in owning a car if you can't travel outside of that zone, or can only travel 50 times a year, or whatever the hell it is that they choose, depending on your own credit score and whether you had a steak last night or whether you ate their bugs. And so while that's all taking place, I noticed that there is, because what that does is it leaves a vacuum. So I was just talking to a friend about this the other day. Emirates Airlines, for example, just posted their biggest quarterly profit. They're now, Dubai is the largest by international transfer airport in the world. They're expanding. And then you're seeing the same thing with Turkish Airlines. Istanbul Airport's the fastest growing, I think, in the last decade. So they're sucking up all of this business. Now, if you and I were, for example, profiting as a consequence of our competition, shooting themselves in the foot, would we stop what we're doing when it's making us wealthy? In most probability, we'd say, no, we wouldn't. Why would we stop this? This is fantastic. So again, things don't happen in a vacuum. So we're seeing this divergence in the world on an international basis, as well as even on a domestic basis. Certainly you guys have got it in the United States, whereby thankfully you have multiple states who still have fairly great levels of judicial power to be able to forestall some of this and to go the other way. So and that just really makes me believe that we're going to see a splintering of the United States. I think the divorce is already obvious. It's just that you haven't figured out who gets the silverware.
Well, I don't know, because I think a lot of the Democrats, after they ruin states like California, New York, Massachusetts, Illinois, they leave because they can't pay the taxes that they voted for, and all the crazy politicians, the rules, regulations, the champagne socialists, hypocrites that they elected, and they leave. So they're leaving to Texas, they're leaving to Florida as fast as they can to escape the taxes and the other rules, regulations, and red tape.
Yeah. Look, Florida had, I think it was the greatest net migration they've had in their history last year. And it's not a surprise to me. So capital goes where it's treated better or best. And so, but that's true on a domestic basis in the US, and it's also true on an international basis. And people will make decisions that they hadn't thought they would consider making purely as a consequence of things getting so bad that you you make those decisions. You might have had someone who said, you know what, I'm never going to leave New York or wherever it is. It's my family's here, and da 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 da. But then you get to a point where if you haven't got work and you're going to lose your home, or you've already lost your home, people make decisions that they wouldn't have thought they would make otherwise, because it's easy for us to make a judgment call when things are running well. But when things get really bad, that's when we make decisions that diverge from what you would have thought. And we're seeing that taking place now at scale. And I don't see that trend going away.
Yeah, I think a lot of people wouldn't realize this, but many decades ago, a lot of New Yorkers actually escaped to New Jersey, where taxes were low and there was less rules, regulations, red tape. Now, decades later, things are the opposite. I think New Jersey has some of the worst taxes, rules, regulations, and very punitive divorce laws. And there's even, I think, a death tax if you die in the an estate tax, a higher death tax or estate tax if you die in that state. So it just shows that how things can change quickly. Chris, since you are an experienced venture capital investor, I want to get your thoughts on this technology bust in Silicon Valley, in China, and how you think it might affect the regional banks and SoftBank.
Oh, shoot. Well, okay, so I got out of that business in 2016 because I thought things had gotten loopy. Here we are in 2023. So it started crashing in 2018. I was kind of 2 years early. But remember, that's a very illiquid market as well. There's no mark to market. Your mark to market basically comes about as a consequence of additional rounds of financing. So let's say you've done a Series A at, $50 million valuation, and you can do a Series B at a $150 million valuation, even where that Series B might have actually only been a tiny amount of capital. Let's just say in your first round of capital, you raised $10 million. Okay. You could go out and you could raise $1 million on a Series B. And I started seeing this sort of shit going on. And you could do your Series B with raising $1 million, and you could do it at like a $150 million valuation. And so now on paper, guess what's happened? You've made a ton of money, and everybody who's come along for the ride has made a ton of money on paper. And if you can roll that up and sell it off to a SoftBank, and they're clearly one of the most egregious in the space, then you can actually bank that particular check. So this sort of stuff was going on years ago, and it just got worse and worse. And so my take on, the Silicon Valley Bank thing, I haven't investigated very deeply, but from what I've looked at, it didn't have anything to do really with Silicon Valley per se, or with tech per se. I think one of the huge problems that they had was they went out and they bought about, it was like $80 million bucks of hold to maturity 10-year notes, and they bought them at I think it was 1.25%. So they basically got hosed as rates moved higher. So their collateral was not quite what it was prior, so they needed to raise a bit of equity capital. People got a little bit skittish, and so we had a bank run. But frankly, you can have a bank run with any banks because none of them have got any money. People don't realize that.
This is the problem with fractional reserve banking, yeah.
So, that's really just indicative of a couple of things. One, look, that's been the case for a long time. The issue now is that we have, especially with social media, you have the ability for information to flow very quickly, and people can panic. So, you could get someone like Peter Thiel, and this is where it started. Peter Thiel freaked out, from what I can tell, and said, hey, get your money out of the bank. And then, of course, that gets shared on social media, and within bloody hours, you now have a mass of people all sharing this information. And it's a shoot first, ask questions later situation. So that's going to be in play anyway across any banking system. And if you think about how that speed of information flow and how one can panic, how that combines with a fractional reserve banking system, you can see that they're fairly incompatible. So
Don't you have a
But
lot
look,
of losses too for a lot of these equity investments? Because Silicon Valley, didn't they have a venture capital investment portfolio? They were owning equity shares of some of these tech companies, or they were giving loans to these bad tech companies that didn't have profit. So they were going to have to mark down some losses. And SoftBank has a lot of those too.
SoftBank I wrote an article, I think it was 2018 or something about SoftBank. And I mean, it's amazing to me it's managed to last as long as it has, because it is the behemoth in that space. It has been the one exit valve for much of the for many businesses. It was always kind of like, oh, you get big enough and then SoftBank will buy you, right? Or you get big enough and SoftBank will fund you and you can get partial liquidity. That was kind of just became the thing. It's almost like it's almost like Amazon buying you, right? If you were a online retailer, right? Or Facebook, So that's a systemic problem, especially when their entire business model is based on growth, never-ending growth in that space, and that requires additional capital pouring in. And that additional capital pouring in requires M2 money growth to be continuously higher, which is why I mentioned earlier we've got a problem. And that problem is that M2 money growth has gone below zero. And that's a big problem. That's credit contraction. So we've got credit contraction coming again at the time where you have a lot of these unprofitable businesses. And the other thing that I joked about some time ago was, I saw I can't remember who it was a fairly well-known venture capitalist in Silicon Valley, funnily enough, talking about, how to go greener and chastising the energy industry and da. And I just laughed because I'm like, the very running of your business requires electricity, and you have not figured out how you actually get that electricity, because all your fancy apps that you build don't work unless you can charge your phone, and they don't work unless you can actually build that app, and that requires electricity. And then, of course, even the phones that people utilize, they are made up of elements that get mined. So there's just a massive incongruence between people's understanding of ultimately what matters and what is needed, what's necessary, which is why I alluded to Maslow's hierarchy of needs at the beginning of this call. So you've got all these unprofitable businesses. Then you've got your Maslow's pyramid, if you will, most of which is deeply undervalued at or below cost of production and in shortage of supply, with an inability to bring additional supply on quickly. Right. And because they're capital intensive, it's not something that you can bring about rapidly. If you want to go and build a drill rig and go or any of these things, you're looking at years. So we have this wonderful setup with respect to this constriction place sort of taking place in that industry, while at the same time there's still an enormous amount of capital sitting, waiting, hoping for an inevitable comeback in tech. We just alluded to the other day in a newsletter we put out, Kathy Woods' ARK, which has lost billions in over the course of the last couple of years, while still raking in like about $300 million in fees. And what it tells me is that retail investors, because she's pretty much retail oriented, retail investors believe that they're just waiting for the comeback. They're waiting for the comeback.
But it looks like this is going to be a larger tech bust, as big or larger than 1999 and 2000, because there's even more size and scale for some of these companies.
Oh, it's gotten way bigger. When I saw, when I saw the problems in the space, and I got out of the venture capital world, like the situation we're in today is so much more egregious than that then. So, yeah.
The other thing I see, Chris, is that SoftBank and a lot of these pension funds too. That's the other thing. I think there's going to be bailouts for these pension funds. There's going to be losses and bailouts. A lot of these pension funds don't even know they have losses yet. because of the accounting that they've given to private equity and these hedge funds that they were feeding money to. I think we're going to see large losses in commercial real estate because a lot of these companies, they're going to have workers work from home. They have sales dropping. Consumers aren't spending as much for certain discretionary items. I think the landlord wants to raise rent with the higher interest rates, their carry costs. I don't think we're going to see a lot of commercial real estate space used. I think there's going to be a big downsizing, and that's going to just wreck commercial real estate in the United States.
Well, there's a funny story that you probably don't know about me. So when I got into the venture capital business, one of the primary reasons behind it, we'd come through 2008. I thought that would be a correction in terms of solving some of the excess problems in the credit system, which it wasn't. Basically, they bailed it out, kicked it down the road, and I thought, shit, now we have even higher risk. But once they've taken that step, they're going to have to proceed with it, and they did. And what I knew was, for example, in the pension industry, which you mentioned, your pension funds are mandated to hold a certain amount of fixed income, and that fixed income space was going to underperform as a consequence of rates being pushed lower and lower and lower, right? And so you can't get the required returns on your pension schemes to basically break even. So and you're mandated into investing into these instruments which are yielding less and less. So what do? Well, you take higher risk on the portion of your portfolio where you are allowed to take risk. And the highest end of the risk curve was venture capital. So I was like, that's where capital is going to go. So I went and built a business in it, and it worked. Now, what we've got a situation today is almost the exact opposite. So you've got these guys holding, as you mentioned, holding all these assets. Again, they're not mark to market, they're mark to model. And that model is basically going to start hitting when you've got the runway on these companies goes away. When that additional capital does not come in to fund a company, you can't pretend the valuation is anything when it's actually gone away and they can't meet payroll. So now you have to mark to market, which is it's gone tits up. And so yes, I think we're going to see a big constriction in that space. Pension funds in particular, that portion of their portfolio which has been sitting in risk, whereby they were hoping for and often getting the returns that made up for the poor yields on bonds that they have to, by law, own, is going to go away at the same time that the bonds that they do own are going to get devalued as a consequence of inflation. So I can't think of a worse business to be in than in pensions. And I don't think most people realize, but their pensions, especially if they've got fixed pension plans with governments, are toast. They're gone. They're going to default on them. I'm 100% certain of that.
So last question before I let you go. With these rate hikes, I don't think the Fed's going to necessarily cut rates very quickly. If rate hikes stay at these levels, do you see a lot of bankruptcies? Do you see dividend cuts? Do you see a bust in commercial real estate in the United States?
I don't like making judgment calls on real estate, largely as a consequence of, broadly, real estate's synthetic to the bond market, especially in a world where, in the Western world, where it's leveraged. So I'm not favorable towards real estate. But that being said, real estate is often a very localized market, so you got to be careful of that. For example, are we contrasting real estate in, say, Florida to Seattle? No, they're very different markets, right? And they're driven by different fundamentals. One's a blue state that's going very much down a very Marxist socialist path. Another one is not. So it's difficult to kind of make that judgment call. But as a whole, where the bond market goes and where rates go is going to affect real estate, whether it be commercial or retail, doesn't matter. So I'm I wouldn't want to be getting into real estate in the Western world, at least. I think it's problematic. Where does the Fed go with rates? Well, they kept mentioning that they're going to keep raising, and and to some extent, what I think they've been trying to do is actually corral international capital in at the same time, while just acknowledging, I guess, that it's going to be problematic on a domestic level. But at the end of the day, look, they don't care. They only care. The Fed cares about the Fed. They care about the big banks, and they care about it's. They work for their shareholders, and their shareholders are not you and I. So, where do they go with rate hikes? I feel like they kind of need to. They're going to need to possibly pivot, but then I'm not prepared to bank on that. And at this point, I don't think it matters. I think it's largely noise for the grand bigger picture, which is that we are in a bond crisis, and this is an international sovereign debt crisis. So if you think about that from that perspective, moving rates around in the US, in Europe, in Japan, you're moving around chairs on the Titanic. It doesn't matter. It really doesn't matter at this point. The numbers, Jason, are so egregious that 50 basis points here, even 100 basis points there, isn't going to make the tiniest difference to the overall grand picture. So,
the interest payments we're almost at $900 billion a year just in interest payments on the national debt, and that's hardly any debt has even been rolled over yet.
Yep. And look, you and I can sit here and see these numbers, but if you're an international holder of debt at scale, i.e. a central bank that is simultaneously being chastised and threatened, what are you going to do? So again, nothing happens in a vacuum. We're moving into a situation where I think we're going to have an international. We're in it. We're in an international debt crisis, whether people realize that or not. But I don't know whether it's sort of a slow bleed one, or it'll probably have fits and starts to it with events that scream across our pages and people freak out about, like the Silicon Valley Bank scenario. And they keep playing whack-a-mole with everything. But ultimately, when I look 5-10 years out, we're going to look back on this and say, well, a lot of those little stories were really just noise. In the grand picture of things, which is a sovereign debt crisis. And in every sovereign debt crisis that you look at in the past, and by the way, this one will be the biggest, largely as a consequence of the numbers involved, but also because this is the reserve currency we're talking about. In every crisis of that description, you basically want to be owning hard assets. You do not want to be owning anything that's reliant on credit, and on growth. The whole tech growth industry, I think, is extraordinarily problematic. The most egregious and stupid of it all is things like monkey JPEGs, which only have value in a world awash with tons of available liquidity, and that's going to become problematic.
Yeah, especially with high interest rates and consumers and their credit cards, and people are draining their savings to maintain the standard of living. You even have countries like Japan, just to defend their own currency, they're selling treasuries to raise cash for dollars to defend their own currency exchange rate. And then other countries that are running trade surpluses, they're not buying treasuries, they're buying gold.
Mm-hmm. You got it.
Well, Chris, I really enjoyed our time today. If my listeners want to check out your paid newsletters or follow you on Twitter, how do they do so?
Twitter is at capitalistexp, and my website is capitalistexploits.at.
And just talk about some of the newsletters you have for people.
Right. So we've got a newsletter that kind of actually began as a newsletter to our clients for our asset management business, Glenorchy Capital, and that's then translated into something that we publish and sell. And really, what we do there is kind of every probably 10 days, we put out a fairly extensive newsletter covering geopolitics, macro environment, asset allocations, things to watch out for, really just kind of keeping ourselves and our clients abreast of what's taking place in the world, and trying to make sure that we're ahead of it and positioned accordingly. And that's pretty much it. So we publish that. Like it ends up being about every 10 days, depending on what I'm up to. And it comes with like monthly webinars, Q&A sessions to cover off what questions that people have got and things of that nature.
And we're in a very difficult environment. Is this the worst one of your career?
I'm not sure I'd use the word worst. It's funny, I made the statement just recently with some mates of mine, and I said, the situation that we have today, I'm really glad that I'm not 25 years old. I'm also really glad I'm not 75 years old, because I not have the energy to deal with it. So I feel like I've kind of been primed all my life for at least some of what's taking place. Certainly I wouldn't, if it's going to happen, and it's happening, then I'd much rather it happens to me now that I'm 45 and I've got a few years of experience under my belt, and just feel like I know a lot more about what's going on. So from that perspective, I'm like, yeah, it's kind of it's kind of the best time of your life to have it. Certainly, if we go back through history, these sorts of periods are monumental changes. We're going to look back, I think, if I'm right, in 10 years' time, and the world's going to be completely different. Much as has happened, this is a cyclical thing. Roughly every 100 years we have this. So we shouldn't actually be surprised that things feel so chaotic. So it is important to understand it within context. And we also know that this is a time when typically you have enormous transfers of wealth. So risk is high, but so is reward. And look, whether we want it or not doesn't matter. We've got it. You're thrown into the swimming pool and you have to swim. So here we are.
I agree. And there's also opportunity and crisis. So the Chinese characters, I think they're the same for crisis and opportunity.
They are. Yeah. Yep. You're right. What's that Chinese curse? May you live in interesting times.
Well, I'm not sure I like this one here, where all the rules changes and the threat of like social credit scores and central bank digital currencies and all these.
It's not going to work, Jason. Mm-hmm. It's not going to work. Look, again, when I ran venture capital, we did a lot of tech stuff, and having the tech available is one thing. Having the ability to implement it and maintain it at scale is a whole different thing. It is a whole different thing, and they don't have that. So I'm not 100%, but I'm like 80% convinced that it's going to fail. The question isn't for me whether it's going to fail, but it's how is it going to fail, and who gets impacted, and how bad does that process work before it gets flushed out and we have to do something else. That's more the question. And so it's like this period of incredible turmoil and attempting to sidestep all of that, and keep afloat, really. So that's kind of how I see it. I might be wrong, but we invested into a lot of these companies. We used to get pitched about 40 deals a week. So I got pretty good at figuring things out like in that space. And when I look at this, what they're trying to implement here, yeah, sure, the tech exists. But their ability to implement this is just nowhere near, and their ability to maintain it is nowhere near available. And I don't see it. I don't see it working. There's so many failure points that, and look, they've failed already. I mean, they try to implement the whole vaccine travel pass thing, which fizzled out. It's difficult now. And now we're moved into a world which is much more fractious. Trying to get additional countries on board with one of these passport systems becomes increasingly difficult. What you're going to keep? You're going to keep ostracizing every country that chooses not to abide by this. Well, you keep eliminating more countries. So I think we can move into more of a sort of multipolar world, but I don't think it's gonna succeed at scale. So that's a good thing, but it does mean that there's a lot of pain to go through before we have some resolution, and that could be a decade out.